Hello and welcome to the paid weekly recap for the week ending August 29th, 2025. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel, and the creator of the artificial intelligence behind the predictive AI for dynamic market system. Before we get started, normal disclosures. Options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC or FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented in the trade ideas. If you need another few moments with the disclosures, please go ahead and pause the video here. Otherwise, we'll get into the recap for this past week. And the week is getting into Groundhog Day. We've continued to maintain a range in the 10-year yield. We dropped down to 4.2% off of non-farm payrolls at the beginning of August, rallied back up as we started to see some other economic data, and approached a potential breakout for the market after Powell's speech at Jackson Hole. 10-year yield remaining range bound throughout this. 4.2 to 4.35% has been the recent range. And we had been pinned close to 4.4, a slightly lower interest rate, not having a huge impact on the market overall. Not a major shift here in many ways. So let's get into the actual equities markets. The S&P 500 attempted to break out on Thursday, but then on Friday we had PCE data which showed that inflation remains high. 2.9%, a rise from 2.6% the month prior. This put a little bit of concern to the market as we see inflation starting to come up. And as inflation starts to rise, there are concerns about the Fed's ability to lower interest rates. And as a result, the breakout attempt on Thursday afternoon turned into a failed breakout once again. The market continues to make new highs, but then fade afterwards. So we've not gotten into a consistent bull trend the way that we've seen in the past, or the way that we saw back maybe at the end of June, early July, where we had a bull trend run for a week or so. Right now, it seems like every time we get to the lows, we go just enough to get to a new high and then retest lows, making lower or higher lows along the way, but not in a meaningful way that gets true momentum to this market. Tech, on the other hand, is holding back. There's been rotation within this bull market. So that chop is most visible, I think, right now in tech, where tech is not able to make the new highs. Earnings have not justified it. Still concerns over maybe tariff impacts, negotiations with other countries, and a lack of interest in going into the heavy growth stocks that generally signifies true bullish behavior for the overall market. So while tech continues to trade sideways and not go to new highs, where is that money flow going? Well, it's in small caps. So over the last 6 months, this is a new high for small caps. It actually made a new high on Friday in spite of the inflation data. Now we're not back to all-time highs. All-time highs were made back in November around 245 for IWM. The high on Friday was 237. So we still have 3-ish% before we can achieve that new high that the rest of the market and tech had made for the last 6 months, if not the last few weeks. Now, overall, small caps seem to be getting that rotation, and we're getting a market that is trying to determine what is best to buy under the current fundamental situation. And small caps seem to be taking some of that buying now. So along with the chop to highs, we're rotating within sectors out of growth and into maybe some value and some more small cap type names, which are dominated in terms of sectors with financials, healthcare, and industrials. So it's a bit of a different market than we've seen, people looking for value as opposed to looking for extreme growth for the overall economy. The VIX had made a new low on Wednesday, but then started to rally back on Thursday in preparation potentially for the Friday inflation data. And then we ended up getting back to 16%. So after touching 14% or getting very close to that level, the market implied volatility started to rise. A little bit more fear in the market, a little bit more hedging as the breakout did not confirm. So it looked like people are starting to buy some puts. People are a little nervous that we may get a dip. This is not a panic situation. There's just a little concern, maybe a lack of interest in selling calls, and more importantly, an interest in having a hedge for a long portfolio in case this dip from Friday turns into something worse in the upcoming week. Now, along with that false breakout, we did have two trades this week. Now, Johnson & Johnson ended up slightly higher on the week. So from Tuesday's open to Friday's close, up about 50 cents. Implied volatility in Johnson & Johnson, however, came back down. Now, Johnson & Johnson's been on a tear. Bullish earnings had a little consolidation at the end of July, early August, followed by a bull run. And then this week we got a dip. And now the dip is partially impacted by having a dividend taken out on Tuesday. So they paid out a dividend and that drops the stock price as the dividend goes out of the share price. With that 50-cent rally in the stock and the implied volatility dropping, the options actually depreciated in value by about 16%. Now we'll look to exit the rest of that position on Monday, or Tuesday. The market's closed on Monday. So we'll be looking to exit the remainder of that position on Tuesday. And with that bull flag setup showing, we may get to see some continuation into Tuesday, and that would be a great add-on for the Johnson & Johnson trade. Rig has been testing a potential breakout. Now, this is an oil driller. Had very heavy volume buying October 3.5 calls to start this week. Now, we ended up in the September 3.5 calls, looking for that continuation, that big buyer of October 3.5 calls to be right sooner. Now, ultimately, he may be right later. Maybe it takes a few more weeks. Bumped against the 200-day moving average and failed. So didn't get the breakout, didn't get the continuation, much like about everything in this market. So attempted breakout, for now it's failed. The options dropped by 33%, very cheap options in dollar terms at 6 cents per contract down to 4 cents per contract, 1.6% loss in the stock and a 30% loss in the options. The buying interest in the October 3.5 calls settled in after just a couple of days. So we'll see if that comes back in at the beginning of this week. And if it does, that may give another potential boost to both rig and the options. But time will tell on that. So we'll be watching that closely on Tuesday. Now we also have one more new trade coming in this week. We'll be exiting the Johnson & Johnson and rig trades. Got a new trade coming Tuesday morning, so please keep an eye out for your inbox for that. And also, please keep an eye on the trading room. If you have questions about paid trades or any trades in this market, the results speak for themselves here. We've had some great ideas out there in this chopping market. We look at a lot of credit spreads, calendar spreads, et cetera, things that can perform a little bit better in a sideways market for a number of stocks. Now, there are still stocks out there that can be setting up a bull trend, and that's why we have the paid signals. But when we have fewer names doing so, there are still opportunities out there, just a different type of trading environment than the bull run that the market just continues to grind higher a quarter of percent a day. We'll look to see if that can take foot this week, potentially after non-farm payrolls on Friday, perhaps ahead of it. There may be a little bit of hedging activity ahead of non-farm payrolls, as we've seen prior to the Jackson Hole announcement by Powell a couple of weeks ago. So time will tell on how all this plays out, whether the market goes in for some hedging, investors look for some hedging opportunities and some risk reduction, or decides that each of these dips continues to get shallower and shallower, and at some point, I just got to buy. If you have questions about anything, please feel free to reach out. I'm Keith at yellowtunnel.com, and Vlad can be reached at vlad@yellowtunnel.com. Thanks again, and looking forward to another interesting week in this market.